Let's talk about standard deviation. It sounds intimidating, right? Like something only mathematicians and statisticians need to worry about. But trust me, understanding standard deviation is incredibly useful, especially if you're an investor or even thinking about investing. It's a key concept in understanding risk, and knowing your risk tolerance is paramount to successful investing. So what is standard deviation? Simply put, it measures how spread out a set of numbers is. Think of it like this. Imagine you're throwing darts at a dartboard. If all your darts land right on top of each other, clustered tightly around the bullseye, that's low standard deviation. Very consistent. But if your darts are scattered all over the board, wildly inconsistent, that's high standard deviation. Now let's apply that to investments. Instead of darts, we're looking at returns. Investment returns aren't constant. They go up and down. Some investments have pretty steady returns, while others are all over the place. Standard deviation tells us how much those returns typically vary from the average return. Let's use some simplified examples. Imagine two investments, stock A and stock B, over 5 years. Stock A returns 10% each year. Every year, like clockwork, 10%. That's incredibly consistent. Its standard deviation would be very low, essentially zero, in this perfectly consistent scenario. Now let's look at stock B over the same 5 years. It returns 5%, 15%, 10%, 20%, and 10%. The average return is still 10%, the same as stock A, but notice how much more variable those returns are. Some years it's doing great, other years it's lagging behind. Stock B will have a much higher standard deviation. Why does this matter? Because standard deviation is a measure of risk. A higher standard deviation means higher risk. It suggests that the investment's returns are less predictable, and there's a greater chance you could lose money. While higher risk can mean higher potential rewards, it also means a higher probability of significant losses. Think about it from a practical perspective. Let's say you're saving for retirement. You want a reasonably predictable path to reaching your goals. You might prefer an investment with low standard deviation, even if the potential returns are a bit lower. You value stability. On the other hand, if you're younger and have a longer time horizon, you might be more comfortable with higher risk, higher reward investments, those with higher standard deviation. You have time to recover from potential downturns. Standard deviation isn't just about individual stocks. It's used to analyze mutual funds, ETFs, and even the overall stock market. When you look at a fund's fact sheet, you'll often see a number listed as standard deviation. This tells you how volatile that fund has been historically. Now let's talk about the math, but don't worry, we'll keep it simple. The actual calculation involves finding the average return, then calculating how far each individual return deviates from that average. Then, you square those deviations, average those results, and finally, take the square root of that number. It sounds complicated, but thankfully, you don't have to do it by hand. Financial websites and investment platforms do all the calculations for you. What's considered a good or bad standard deviation? There's no single answer. It depends on your risk tolerance and your investment goals. Generally, a lower standard deviation is preferable for conservative investors, while a higher standard deviation may be acceptable for more aggressive investors. A common benchmark to compare is the standard deviation of the S&P 500, a broad market index. Comparing an investment's standard deviation to the S&P 500 can give you a relative sense of its risk. It's also important to remember that standard deviation looks at past performance. It's not a guarantee of future results. The market can change, and past volatility is not necessarily indicative of future volatility. However, it's still a valuable tool for understanding the historical risk of an investment. Another key point: standard deviation doesn't tell you why returns are volatile. It just measures the volatility. A stock could be volatile due to company-specific issues, industry trends, or broader economic factors. It's important to understand the source of the volatility before making an investment decision. So to recap, standard deviation measures how spread out a set of numbers is. In investing, it measures the volatility of returns. A higher standard deviation means higher risk, but potentially higher reward. A lower standard deviation means lower risk and potentially lower reward. It's a valuable tool for understanding the historical risk of an investment, but it's not a crystal ball. Understanding your own risk tolerance and investment goals is crucial when interpreting standard deviation. Combining standard deviation with other financial metrics will give you a more complete picture of an investment's potential. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.